Right. We are moving on. As is usual with this course, we march on relentlessly. So now please go everybody to page 303. And this time we are looking at lecture number 21. Record keeping, part 2. And we're looking at the income statement and the balance sheet. Now I've explained to you very briefly what an income statement is. And we're going to go over that, and we're going to take some examples from the work that we've already done, and we're going to draw up an income statement. So I'm going to show you how to do it, what factors to look for, and the way to do that. And then we are going to go through the balance sheet. Has anybody in the class had experience with an income statement before? Income and expenditure statement? No one? Oh, you have, Portia. Okay. And Spoo a little bit, eh? Balance sheet? Okay, Portia has. Okay, you've had a little bit, Temba. Little. Okay. Do you know how to work one out? All right, we're going to teach you that. We're going to teach you that. So as usual, as you've heard from this class, we use the KISS principle. Keep it straight and simple. So we're going to keep it as simple as possible. All right. Income and expenditure statements can be also called profit and loss statements. So basically it is a statement, generally a one-pager, that summarizes everything that you are doing. Okay, so the main purpose of the income statement, so by the way, an income and expenditure statement is often abbreviated to just use the word income statement. Okay, so whenever you hear a company saying the income statement, what they're meaning is the income and expenditure statement. Okay, so it's just abbreviated to the income statement. Okay, the main purpose of the income statement is to inform you on how your business is doing each month and what the state of your cash flow is in. Are you in positive cash flow? Are you in negative cash flow? So the income statement is an outstandingly excellent tool to use in your business to keep track of your income and the expenses by having your cash book for each month summarized onto one page, so that you will be able to see very quickly whether you've made a profit or a loss for that month. Okay, so let me ask you a question. From what I've just told you on the board, how many income statements should we be having per year? Yeah. No. 12. No. 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 It's 12, because you see, actually Hani's not wrong. It's 12 plus 1.
Okay,
13. Because you've got 12 months in the year, so you need to have an income statement for January, February, March, April, May, June, July, August, September, October, November, December, and then one income statement that summarizes all 12. It's called the yearly income statement. So it's a monthly income statement, 12 of them, yearly income statement. Now, what you may or may not have known, and if you may not have known this, I'm giving you new information. If you did know this, then this just strengthens the information I'm giving you. When we say goodbye to each other, in other words, when this class ends on Friday, okay, it does not mean that our relationship with you ends. Because you will be followed up for a period of 12 months minimum. Okay? And we're going to appoint certain people in the class. Val will join me at around about 3 o'clock, and we will tell those of you who are in class whom Val and I feel are the ones that could be trained to do the follow-up work, and then there is a potential of being able to train you as trainers at a later stage. Okay, provided you do the follow-up work properly. Now, when you are being followed up and you're running your business, one of the things that the person, the follow-up coach, is going to say to you is, show me your income statements. Because those income statements are going to be, we're going to keep those, we don't want to take them. So what we're going to say is that the follow-up coach must take a picture of your income statement so that we have a record of how your business is doing, and so that we can see, is it going like this? Is it going like this? Is it going like this? And by the way, the whole reason that we are putting follow-up mentors and coaches in place is to help you, Wendy, to improve your business. Put into practice what you're learning on this course by starting your business. Okay. So they'll want to see this. So you've got to get to know how to write one up. Okay. All right. You're looking all so enthusiastic. Can't wait. The monthly income statement will show you the following. 1, how much money you've made overall from selling your product. It'll tell you how much you spent on your variable costs as one figure. It'll tell you what your fixed costs were, how much you paid on loan repayments, and how much your profit and loss is for the month. This is what one looks like. Okay? Now, generally speaking, when you look at the income statement of companies, they will generally have all of these things down the side, but only one column. And I'll be explaining that in a moment, why we put 2 columns and why they only have 1 column. But let's go through it first. So it is divided into 1, 2, 3, 4, 5 bands. Okay, 5 groupings. Grouping number 1 is the sales, the money that you brought into your business. Grouping number 2 is the variable costs. Grouping number 3, or part number 3, is your gross profit. Number 4 are itemized, all of your fixed cost expenses. Then number 5 is how much you're paying out for loans and your net profit. Okay, so let's now go into it a little bit more in depth. So under sales, and remember when we come here to this diagram, let me just pull the diagram back really quickly. Remember when we came to this diagram here, we said that there are only 2 ways that a business can make money, bring money into the business. Product or service, selling a product or selling a service. And there are many ways that the business money can leave a business, and all of these are the expenses of the business. And they're broken up into variable cost and fixed cost items. Now we're going to separate them out in an income statement. Okay, so money received from selling goods, money received for providing a service. Those are the only 2 ways that one can receive money into the business. Total money received. Now, some income statements also have, and it's not wrong, it's perfectly fine, what your bank balance is. So in other words, how much interest has come from the money that you've got in the bank. Okay, that could be another way that you would receive money into your business. Okay, but that's going to be very small, really. Okay, now what we do is, so this column here would be writing all of the figures, the itemized figures. So if you come here, it would be, this is where you'd write your owner's salary. This would be, you write your employee wages, your premises rental, equipment rental, and so on. Okay, so that would be in this column, the itemized things. This column is the totals. So you would take, if you are selling products and services, so you put the price for the product there, price for the service there, you'd add them up and put them in that block there. Okay? If you're doing your raw materials, the various items of your raw materials, add them up, put them there. And the reason that we've done this is because it's so easy to be able to take this figure, which is your total income in your business, minus this figure, which is your total variable cost, gives you your gross profit. And then here are all your fixed costs, and you add them up and put them in there. So your gross profit minus your fixed costs minus your loan repayment equals your net profit. Now, so this is an unusual way for an income statement to be written out. It is, I think, in my humble opinion, the best way. But that's not the way accountants think. So what accountants generally do is, you see where it says variable costs there? This block would have the total. Okay? So they don't have total variable costs. They just have variable costs, and this block would be the total. So you'd add this, this, and this, and put the answer up there, which is to me a little bit backward, because you always add things and put them below, you know. And so some of them would have, you know, you would be able to add up here. But then the reason we've put this column is so that you can see, what do I take away from what? Because if you've got numbers here, 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 and here, and numbers here, 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 and here, you can get confused as to what to take away. You know, what you minus from what. And that's why we've created this column here. Okay. Everybody with me on the way it's written out? Hani?
Okay, you're moving too fast. I just want to ask, like the total money that you receive is going to be there, I see. Then you do that variable cost, you are going to minus the total money you receive, and then you minus the total variable cost from the money that you receive. Okay, so you're going to write in here the total of monies received, and there the total of your variable costs. And then so you don't minus anything from it, you only minus it when you get to your gross profit. So after that variable cost, what are you going to do on the gross profit?
You're going to take your total sales minus your total variable cost, which comes to your gross profit. So ultimately, I'm teaching you nothing new.
Yes.
You've done all this before. Nothing new. I'm just presenting it in a way that you can actually summarize, because that's what an income statement is, summarize your cash book.
So my last question, this figures is like, is for 1 month or like?
1 month.
Okay, so you have to have this for all 12 months?
Correct.
Okay.
And then your 13th one, which then your 13th one would take your total money received for 12 months and your total variable cost for 12 months. So in other words, you'd see, did I make a net loss or profit for that year?
No, I think it's a very simple way, because there is no dates and everything, like everyday record.
No, but however, if you are not keeping your daily records, you cannot do this. It's impossible. So you have to be keeping your cash book. Have to be keeping. It doesn't replace your cash book. It summarizes your cash book.
It's very simple and easy, this thing.
It is very simple and easy. Okay, so let's go through rather what is you can put under your variable cost. So, money from raw material or goods. Goods is another word for products. Okay, so your money for your raw materials or your goods. Money for transport. Remember when we did the cost categories, we said money for transport was a variable cost item. Money paid for commissions. What is that? Sydney? Employee bonuses. I don't like the term employee bonuses. You are on the right track, however. Mr. Jerome.
Okay, if let me try. I think it's the money that you pay people that are not permanent, who are working in a company, maybe on daily basis on what they bring in.
Okay, that's a very close answer. He's getting very close to getting this third suite, you know. The rest of you are lagging behind, unfortunately. Okay, so sometimes we don't want to have a wage bill. We want to employ people, but we don't want to have a wage bill. We don't want to be paying them on a monthly basis. So what we do is we say to them, and this is why it's put under variable costs, by the way, because normally wages and that are put under fixed costs. We say to them, I am going to give you 10 Rand, just as using that as a figure, I'm going to give you 10 Rand for every product you sell. So if Kellis goes out and Kellis sells 100, he's getting 1,000 Rand. But Wendy only sells 10. So therefore she's getting 100 Rand. He's getting 1,000, she's getting 100 Rand. You know, Spoo decides it's not going to work, he's getting 0. Faik only sells 2, he's only getting 20 Rand. And that's why you put it under variable costs, because you're not paying everybody the same price. You're paying various people various bits of money depending on how much they are selling. Okay, so it's what's called selling on commission. So if you come across a company that says, and they say to you, we are going to pay you commission only, that's going to be how many you sell is going to determine on how much money you're going to earn. Okay. Any questions about that? Quite clear? All right, Jerome.
So which means commissioner, if it's about energy, you must have energy in order to sell more products, in order to get more.
I suppose so. You know, so for instance, you know, you can have one person that is just standing there at their place, and they're waiting for people to come and buy. Okay, you get another person who's going door to door, and you get another person who goes to a shopping center where a lot of people congregate, and then they're doing presentations to maybe 10, 20, 30 people at a time. So obviously the person that puts in more effort, who's there at the shopping center doing presentations to 20, 30 people at a time, is highly likely to make more money than the person just waiting for somebody to come past their place, you know. So therefore, why companies do that is to try and promote you to work as much as possible. And then some companies even have, we'll give you a basic and then commission on top of that. So I think that, Felicia, that's how the insurance industry works, isn't it? Yeah, gave you a small basic and then commission on top of that, whatever you sell.
Some of cars.
Sorry?
Some of cars.
Yeah, they do that.
The car, 25 Rand, 10 Rand is yours. For the use.
By the way, you know, that's how the taxi industry works, you know that? Small basic and commission. Because the taxi owners say, you know, drive your taxi, I'm going to give you 1,000, or whatever the price is. Any money you make over, that's yours. And that's why they drive like crazy. All right, then of course, so you put in variable costs there, transport costs there, commission costs there, add them up, put them in that column there. Okay, then your fixed cost, obviously you're just writing out all of your fixed costs. Why do you think we need to itemize it in your fixed cost? Why don't we just say fixed cost? Because if they're fixed, they're fixed. Why waste all this space? Okay.
Yes, I think.
Kellis?
I think we need to know how much money we are spending.
Okay. How much money are you spending on each of them? Yes. But if they're fixed, they're fixed. Do me?
It varies to businesses. For example, if I bought a facility, so I don't need to pay that every month. So
Okay.
so that will be out of that list, rental and
Yeah, I suppose you could say that. It is an answer. Basically, if you look at, let's say, water and lights, okay, you know more or less it's going to come to, let's say, 1,400 every month. But one month it's 1,430, the next month it's 1,388, depending on how many days in the month you've got. So February, which is a short month, 28 days, you haven't got 29, 30, 31. You haven't got 3 days in the month. Now 3 days can be quite a lot of electricity or water use. And so that's why, so that these ones here, even though they're fixed, you know, your premises rental is likely to be the same all the way through. Your employee wages likely to be the same, owner's salary likely to be the same all the way through. But water and electricity, that could vary. Telephone could vary. Bank charges is dependent upon how much money you got in the bank. So there are a couple of where the fixed price won't be exactly. It'll vary ever so slightly. Okay, and that's why you list them out. It's also so that when you're looking at, when you're comparing, let's say February with April, then you can say, but wait a minute, this went a little bit high. Why did this go a little bit high? Why did, you know, and so you got a way to compare. Okay. So you're writing in all of your fixed costs down here, and you're adding them together and you're putting them in there. And then it's simple mathematics, as you've known. You take your total sales minus your total variable cost, gives you a gross profit. Gross profit minus fixed costs minus the loan repayments would give you your net profit. Okay. All right, now I think that I've explained. So this is how you do it, and then we're going to physically do it. So from your cash book, you add up all the money that you've received from selling the goods, and you put it into the correct column. Again, from your cash book, you add up all the money which you spent on your products or raw materials bought during the month, and remember to include all your consumables, which are what you use up. Consume means to consume, means to use up rather. So we have consumed lunch. We've used up lunch. It's sitting in our stomachs right now. So a consumable is things like cloths and cleaning chemicals and that type of thing. Okay. Then you add up all the money you've spent this month on wages, travel, transport, stationery, electricity, or fixed cost items. To get your net profit, you subtract your variable cost from your total sales. This gives you gross profit. From your gross profit, you subtract your fixed costs, your loan repayment, until you've come with a net profit. Right. So let's now skip out of this and go here. Okay. Now, you remember we did Peter's cash book. Remember when we were doing record keeping 1? We did Peter's cash book. Now, everybody will need to go with me, and everybody has to do this together. We are going to page number 306. Okay, and on 306, you will find over here the story of Peter's cash book. Okay, and on the opposite page you will find the income statement. So what we are going to do together is we're going to take Peter's cash book and transfer it to the income statement so you can see exactly how we are going to do that. Okay, let me get my pens. Now I'm going to draw all over this board, and I'm sorry that these are not too, I can't make it bigger because then the board would actually slip off the board. Okay, so this side of it, of course, is the description. This is your income column, in other words, money received from sales. This is your money paid out. This is your balance. Okay, so all you need is this column here and this column here. Okay, that's all you need. Okay, so Now, by the way, let me explain one thing to you. Remember what I said. So this is just a revision of cash book. And when you look down here, above these two green arrows, do you see any time when both this column and this column is filled in? Any time in these two columns where there is a number in this column and a corresponding number in that column? Nothing, eh? Nothing. But there is only one time when they do appear. That's there and there. Okay. So this is at the end of the month, and you have totaled up your total amount of sales and put it in there, and you've totaled up the total amount of your costs and put it in there. Okay? Then you would take your total sales minus your total costs, would give you this figure here. Okay, that is 1,000, just let me write it darker, 1118. Okay, 0.00. That's what it says there. Okay. Now that is what should appear at the end of your income statement. Let's see if we can get there. Okay, so let me just highlight this figure here. So it's 37,080.00. Okay. So that is the addition of all of these figures here. Now, this is your income column. Where does it go on your income statement? Under? Money received from selling goods. This is a t-shirt business. They are running no services. So, we would put here, money received from services, 0. Okay, you all need to be doing this in your books. Okay. Money received from selling products, you can simply take this 37,080 and write it in here. 37,080, 0 cents. Okay? Then you would add those up and put them into that block there. So 38,080 rands plus 0 is 38,080 rands. 37, sorry, 37. Sorry, 37,080 rands plus 0 is 37,080 rands. Okay. Now, so we're done with our income. Now we move to our expenses. Don't worry about the balance. That's not, you're not interested in the balance for this. Okay, now, would you agree that in this money paid out, you have got various costs mixed up? You got some fixed cost items, you got some variable cost items, you got some transport items. Okay, so I believe, as you've heard me say on many occasions, let's work from the most simple to the more complex, right? So which items on here can we identify very quickly? Which expense items in our cash book would we be able to identify very quickly? Not larger numbers. What do we only pay out once every month? Fixed costs, exactly. So your fixed costs generally appear where? When would you pay your fixed costs generally? Month end. So we can say that this here is our fixed costs. Okay? Of course now I need to be able to read this. Okay. Right, so we transfer this to our fixed cost. Is this figure here rental for the shop? Okay, so we find where we're putting rental, premises rental is there, so we're aiming for that point there, and we take that figure and simply write it in there, 4,500. Now, I'd like to suggest, try to write these in columns. So you can see that all of these fours, all of the thousands are written in a column there. All of these figures are written, so try and keep it neat in columns. It's going to be much easier for you to add up when you if you're doing it manually. Okay, and then we tick off the fact that we've moved our premises rental across to our income statement. The next is we are paying the council for our electricity and water. It's 1,200. We go here and we find water and electricity is there. So that's where we headed. So we take our 1,200 and we write it in there. Okay. Next one we look at is 250 Rand. It's telephone. Telephone is there. So we take our 250 Rand, I think, and 50 cents. And this is why it's important that you put in these 0 zeros. Because our telephone account is 250 Rand and 50 cents. And then the only one left is the owner's salary, which is going to come in here. And so we take this owner's salary here and write it in there. And make sure that you are ticking off. Tasman, are you writing? Sorry, you haven't got a pen. Yeah. Why didn't you speak up before, Tasman? Right, now, what I would suggest is that in your income statement, where there are empty spaces, just write a 0. Okay. Once you've done that, you are simply going to add all that is in the red here, and you're going to put it into that block there. So 5,000 plus 3,000 is 8,000, plus 4,000, 12,000, plus 500 is 13,000, plus 1,000 is 14,000, 14,450. And 50 cents. Let me just check. 5K, 5, 10, 14, 1, 5, 10, 13, 14. Yeah, that's right. Okay. Everybody with me so far? Wendy, are you writing? Okay. So what we've done is we've taken our total sales and we've put them in. We've ticked off all of our fixed costs. Now what I'd suggest you do is you actually look through here and find out, are these, so first of all we're looking for any commission. So was anything paid out for commission? Was there any commission? No. So we can put a 0 there in commission. Then we are left with two items to identify: the total money paid out for transport and the total money paid out for raw materials. So we go through here and we say, are there any items that was paid, where there are any transport items?
Yeah.
Which one is it? Say again?
23rd of the 9th.
23rd of the 9th. What was the amount? 400 rand. So it's likely to be that one there, right? Okay. So then you take this 400 rand and transfer it up here to the place for transport. Tick it off. Now basically what is left can only be your raw materials. Okay. So now you'd add up this 3,060, 4,150, 50, 47509, 875, 725. As far as if my calculations are correct, it should be 21,111 rands and 50 cents. That's what it should be, I think. Huh? And then if you add that in the 400, okay, it is right.
Sorry, Chris.
Yes.
From the money for raw materials, where did you get that 21,100?
Okay, so what I did was, so we've ticked off this one, right? Because that's the 400. So what we did is we took this one, plus this one, plus this, plus this, plus this, plus this, plus this, plus this, plus this. And if we add all of that there together, we would come to 21,111 rands and 50 cents. Now you see what I've done? I've ticked off as we're going, just to make sure we're not making a mistake. Then to get your total variable cost, you take the amount of money from your raw materials, 21,111 rands and 50 cents. You add in your 400 rands and 0 cents transport, comes to 21,511 rands and 50 cents. Okay, Kellis? Now it's simple mathematics. We don't have any loan repayment, so we can take a loan repayment of 0 there. Okay? Now, let's ask Wendy. How would we get our gross profit, Wendy?
What?
How do we get our gross profit? From the board. You don't have to tell me what it is, tell me how we would get it.
Yeah.
Yes, but how would we get it? Okay. Singatwa, can you help her? How would you get your gross profit?
We're gonna add from sales.
You're going to take your sales, yes?
And
Remember what you were doing when you were doing your money making exercise. You're taking the total amount from sales and you got your total cost. Were you adding or were you subtracting? Tasman, help them. Subtract. Yes. What do you subtract from what?
The variable cost in the
From the?
debit circularity just now, you subtracted 2 from it.
Yes. So you take this, the amount of money that you've got from your sales, 21,511. That's how much money you've got in, right? Mm-hmm. And you're minusing from that. Sorry, you take the amount of money you got in. Sorry, your 37,080 that you've got in from sales.
Yes.
That's how much money you've got in your pocket. That you've paid out 21,511. So you take 37,000 minus 21,511, which will give you your gross profit. Okay, has somebody done that?
Yes.
What is it? How much?
15,568.
How much is it?
15,568, 50 cents.
15,000?
568.
568 and 50 cents. Okay. So you see that, Wendy? The amount of money you've got from your sales minus what you've spent on your products gives you your gross profit. Okay. Then Wendy, how would you get your net profit? How would you get this figure here? Say that again. Take your
14,000.
Okay, so what do you do with your 14,000? You've got 15,568 gross profit.
Property is 37,000.
What do you mean 37?
Property 14,000.
14,000 Rand is your fixed costs. Okay, Singatwa, help her. So you've got 15,568 gross profit. You've got 14,450 expenses.
6,000.
15,000.
You minus the 14,000 from the 15,000. Yes. So what you do is, you take this 15,568 and 50 cents, and you minus from it 14,450 and 50 cents, and what do you get? 1,118. 0, 0. Same amount. So now you know that you've done a good job. So what is the most difficult thing that you have to do with an income and expenditure statement? What's the most difficult thing that you have to do?
Just to make sure that the right amount is at the right slot.
The right amount is at the right slot, exactly. And what does the right amount at the right slot depend on? How accurate is your cash book? You know, it's the old computer terminology. Those that have worked with computers. Junk in, junk out. Trash in, trash out. So if you have done a good job of your cash book, this will work out automatically. Now there are programs like Pastel, like QuickBooks, and these that you can buy for your computer that will do this automatically. You don't have to do it. You just press a button and it prints it out.